Let's talk about debt. For the vast majority of people, that word brings a feeling of anxiety. We think of credit card balances that never seem to shrink, student loans that linger for decades, or a mortgage that feels like a 30-year weight on our shoulders. This is the kind of debt that takes money out of our pockets. It's a trap, a source of stress, and a barrier to building real wealth. But what if I told you there's another world? A world where debt isn't a trap, but a powerful tool. A world where the wealthiest individuals, the top 1%, don't fear debt. They actively use it. They use it to fund lavish lifestyles, acquire new businesses, and grow their fortunes, all while paying a surprisingly low and sometimes non-existent amount of tax. This isn't some illegal scheme. It's a perfectly legal strategy built into the very fabric of the financial system and the tax code. It's a three-step playbook that has been used for generations to build and protect dynasties. The strategy is known as buy, borrow, die. And understanding how it works reveals one of the biggest secrets to how the rich get richer. The entire strategy begins with the first, most crucial step, buy. But it's not what they buy that matters as much as the type of thing they buy. The wealthy focus their capital on acquiring what are called depreciating assets. These are things that are expected to increase in value over time. Think of large portfolios of stocks, significant real estate holdings, art collections, or even entire companies. The key difference here is mindset. Most people use debt to buy depreciating assets, things that lose value. You take out a loan for a new car, and the second you drive it off the lot, it's worth less than you paid for it. You're paying interest on a shrinking asset. The wealthy do the exact opposite. They use their cash to buy assets that grow. They aren't looking for a quick flip. They are in it for the long haul, letting time and market growth do the heavy lifting. Now let's imagine a wealthy investor builds a stock portfolio worth $10 million. Over a few years, thanks to market growth, that portfolio is now worth $20 million. That's a $10 million unrealized gain. Here's where the paths diverge. If you or I wanted to access that money to buy a house, start a business, or just live on, we would have to sell some of the stock. The moment we sell, that gain becomes realized, and we get a massive tax bill from the government for capital gains. But the wealthy don't sell. Why would they want to give away a huge chunk of their gains to taxes and, more importantly, stop their golden goose from laying more eggs? Their portfolio is still growing. So instead of selling, they move to step 2, borrow. Using their $20 million portfolio as collateral, they go to a bank and take out a loan. Banks love these kinds of loans because they are incredibly safe. The loan is secured by a valuable liquid asset, so they offer incredibly low interest rates. The investor might borrow, say, $2 million against their portfolio. And here is the magic trick, that $2 million they just received is completely tax-free. Why? Because according to the tax code, debt is not income. It's just a loan. So they now have $2 million in cash to spend however they please, all while their original $20 million portfolio remains untouched, continuing to appreciate in value. They are literally living off of their wealth without ever having to sell it and pay taxes on its growth. Of course, this strategy isn't without its dangers. It relies on the value of the assets staying high and the interest rates on the loans staying low. If the market takes a dive and that $20 million portfolio suddenly drops to $12 million, the bank will get very nervous. This can trigger something called a margin call. A margin call is the bank's way of saying, your collateral is no longer valuable enough to secure your loan. They demand that the borrower immediately pay back a portion of the loan or put up more collateral. If the borrower can't, the bank has the right to force the sale of their assets to cover the loan. This is a catastrophic scenario. It means being forced to sell at the absolute worst possible time, when the market is at a low, and it crystallizes the very capital gains taxes the investor was trying to avoid in the first place. It's a high-stakes game, and it requires careful management. This brings us to the final, and perhaps most mind-bending part of the strategy: die. This may sound morbid, but in the world of generational wealth and taxes, it is the ultimate financial planning tool. It's the masterstroke that ensures the wealth built over a lifetime can be passed on almost entirely tax-free. Let's go back to our investor. They've lived a long life, borrowing against their portfolio to fund their lifestyle. Let's say their original portfolio, which grew to $20 million, continued to compound over decades and is now worth $50 million at the time of their death. Throughout their life, they've accumulated, let's say, $10 million in loans against it. That means there is a $49 million plus gain on the original investment that has never been taxed. When they pass away, their heirs inherit both the $50 million portfolio and the $10 million in loans. This is where the most valuable loophole in the entire tax code comes into play. It's called the stepped-up basis. What this means is that the cost basis of the assets is stepped up to its fair market value at the date of death. In other words, for tax purposes, it's as if the heirs just purchased that entire portfolio for $50 million on the day they inherited it. All of the enormous capital gains that were built up over the original owner's lifetime, that entire $49 million plus, are legally and permanently wiped away. Vanished. The IRS essentially forgives it. So what do the heirs do? Their first move is simple. They can sell $10 million worth of the portfolio. Since their new cost basis is $50 million, selling a portion for $10 million results in zero capital gains. It's a tax-free transaction. They then take that $10 million in cash and pay back the loans in full. What are they left with? A $40 million portfolio, completely debt-free, with absolutely no capital gains tax ever paid on the decades of growth. It is the ultimate transfer of wealth. Now, it's true that very large estates can still be subject to a separate federal estate tax. However, the exemption levels are extremely high, and the wealthy employ an army of lawyers and accountants to use trusts and gifting strategies to minimize even that tax. The stepped-up basis, however, specifically wipes out the capital gains, which is often the largest tax liability of all. So that is the buy, borrow, die strategy in a nutshell. It's a powerful cycle. Use your money to buy assets that grow in value. Then, when you need cash, borrow against those assets tax-free, allowing your investments to continue compounding. And finally, when you die, the tax code allows your heirs to inherit those assets with a clean slate, wiping away a lifetime of taxable gains. This is how debt, the very thing that burdens so many, is transformed into a sophisticated instrument for building generational wealth. It's a complex strategy that hinges on appreciating assets, disciplined debt management, and a deep understanding of the tax code. It's one of the key reasons why wealth tends to stay concentrated at the very top. If you learned something new and this gave you a different perspective on wealth and debt, do me a favor and hit that like button. And be sure to subscribe for more deep dives into the world of finance. Thanks for watching.